The substantial presence test is arithmetic. It is not a judgment about where you consider home to be, and it does not ask what you intended. It counts days. If the count crosses the line, the United States taxes your worldwide income. Here is the formula. You meet the test if you were physically present in the United States on at least 31 days during the current year, and at least 183 days across a 3-year window using a weighted count. The weighting is what most people miss. Count every day of the current year at full value. Count 1/3 of the days from last year. Count 1/6 of the days from the year before that. Add those three numbers together. Both conditions have to be satisfied. Falling short of 31 days in the current year defeats the test, even when the weighted total is well above 183. The IRS publishes a worked example that shows how narrow the margin is. 120 days a year, every year, on a steady and unremarkable schedule. That is 120 plus 40 plus 20. 180 days. 3 days under the line. Add 11 days in the current year, and the same person crosses it. Not every day counts. Several categories are excluded outright. Regular commuters from Canada or Mexico, where the commute covers more than 75% of the workdays. Travelers in transit for under 24 hours between two other countries. Crew members of foreign vessels. And days you could not leave because of a medical condition that arose while you were here, though a condition that existed before you arrived is not covered. 2 of those exclusions carry a filing obligation rather than an automatic benefit. Days excluded because of a medical condition or because you were an exempt individual require Form 8843. The exclusion is claimed, not assumed. An exempt individual is not someone exempt from tax. It is someone whose days are excluded because of their visa category. Students, teachers, trainees, foreign government-related individuals, and certain athletes. The limits are real, and they run out. Now the part that changes the return. Meeting the test makes you a resident alien. A non-resident is taxed on income effectively connected with a United States trade or business and on certain United States source income. A resident is taxed the way a citizen is taxed, on income from every country, and picks up the foreign information reporting duties that follow from that. There is one route back. The closer connection exception can preserve non-resident treatment even after you meet the day count, but it has a hard ceiling. You have to be present fewer than 183 days in the current year, maintain a tax home in a foreign country, and have a closer connection to that country. It is claimed on Form 8840, and crossing 183 days in the current year closes the door entirely. That ceiling is why the Canadian snowbird question in Florida is really 2 questions. The weighted 3-year count decides whether you meet the test. The current year count decides whether the exception is still available to you. The day count is simple. What it switches on is not. If your pattern of travel sits anywhere near the line, the time to run the numbers is November, not April.